Pause for a moment and ask yourself a simple question. What happens when the world starts to quietly prepare for a future without you at the center? Not loudly, not with headlines or declarations, but silently, through capital flows, reserve shifts, and decisions made behind closed doors by those who move trillions, not millions. Because right now, something deeply consequential is unfolding. Not in the streets, not on social media, but in the balance sheets of central banks, in the vaults of sovereign funds, and in the risk models of the most sophisticated investors on Earth. And most people have no idea it's happening. For decades, the global system ran on an assumption so strong it felt permanent, that stability was guaranteed, that leadership was unquestioned, and that trust was automatic. Money flowed in one direction because it always had. Confidence didn't need to be defended. It was inherited. But markets don't operate on nostalgia. They operate on signals. And the signals today are changing. When nations begin to hedge instead of commit. When investors insure against risks they once ignored. When safety itself is being redefined, not emotionally but mathematically, that is not coincidence, that is preparation. This is not about panic, it's about positioning. Because history doesn't repeat itself with a warning label. It repeats itself quietly, while most people are still debating whether anything has changed at all. The greatest shifts in economic power never announce themselves in advance. They reveal themselves only after the window to respond has narrowed. What makes this moment dangerous isn't collapse. It's complacency, the belief that dominance is permanent, that credibility renews itself automatically, that trust, once earned, never needs to be defended again. But trust is not a slogan. It is a balance sheet, and right now the world is auditing it. This conversation is uncomfortable, which is exactly why it matters. Because the difference between a system that endures and one that declines is not strength. It's discipline. It's awareness. It's the willingness to confront reality before reality forces the conversation for you. So if you want to understand what the world's smartest money is quietly preparing for, if you want to know why safe havens are rising, why hedging is becoming routine, and why confidence is no longer unconditional, then stay with me. Because what's happening next will define not just markets, but power, influence, and leadership in the decades ahead. For decades, the US dollar has occupied a position in global finance that no other currency could realistically challenge. It wasn't just a medium of exchange. It was the backbone of international trade, the anchor of global reserves, and the default refuge in moments of crisis. That dominance was built on trust in the rule of law, trust in fiscal discipline, trust in stable institutions, and trust that long-term value would be protected. But today, that trust is no longer unconditional. Across the world, central banks, sovereign funds, and institutional investors are quietly adjusting their exposure. They are not abandoning the dollar overnight. That would be unrealistic. But they are hedging against it in ways we have not seen at this scale before. Gold reserves are increasing. Bilateral trade agreements are being settled in local currencies. Alternative reserve strategies are being discussed openly. These are not symbolic gestures. They are strategic decisions made by actors who manage trillions of dollars and think in decades, not headlines. This shift is not driven by ideology. It is driven by risk assessment. Investors ask one fundamental question: does the current trajectory preserve purchasing power and predictability over time? When government debt grows faster than economic output, when deficits are normalized rather than treated as temporary tools, and when political dysfunction interferes with fiscal clarity, uncertainty creeps into that calculation. Markets do not panic, they reposition. What makes this moment particularly consequential is that the dollar's dominance has always rested on relative strength. It did not need to be perfect. It only needed to be more reliable than the alternatives. But as geopolitical fragmentation increases and emerging economies mature, the tolerance for concentration risk declines. The world is no longer comfortable placing all its faith in a single currency, a single system, or a single political framework. This does not mean the dollar is collapsing. Far from it. It remains deeply entrenched in global markets, and no competitor currently matches its scale, liquidity, or legal protections. But erosion does not announce itself with alarms. It happens gradually, through diversification, through hedging, through incremental loss of exclusivity, And once that process gains momentum, reversing it becomes extraordinarily difficult. The real danger is complacency. When leadership assumes dominance is permanent, discipline weakens. History shows us that reserve currencies lose influence not because they are replaced, but because confidence fades. Confidence fades when policymakers underestimate how closely the world is watching, how quickly capital responds, and how unforgiving markets are to mixed signals. De-dollarization in its current form is not an attack, it is a response to uncertainty, to fiscal imbalance, and to a perception that long-term stewardship is being taken for granted. The question is not whether this trend exists. The question is whether it will be acknowledged early enough to be addressed decisively. Because once trust begins to fragment, restoring it requires more than rhetoric. It requires sustained, credible action. In times of uncertainty, capital reveals what it truly believes. It doesn't respond to speeches or slogans. It responds to risk, credibility, and long-term preservation of value. That's why the movement we're seeing into traditional safe havens deserves serious attention. Gold, in particular, is not rising because investors suddenly became nostalgic. It is rising because it has no counterparty risk, no political dependency, and no promise that can be diluted over time. When sophisticated investors increase allocations to gold and other non-dollar stores of value, it is not a vote against growth. It is a hedge against instability. It reflects concern that the mechanisms which once ensured discipline are being stretched and that the margin for error is narrowing. Capital seeks assets that cannot be printed, frozen, or politically redefined. That instinct is as old as markets themselves. What's different today is the breadth of participation. This is not confined to retail investors reacting emotionally to headlines. Central banks are accumulating gold at the fastest pace in decades. Sovereign institutions are diversifying reserves. Large portfolios are pairing U.S. equity exposure with currency hedges, implicitly acknowledging that strong corporate performance and dollar strength are no longer assumed to move in lockstep. That is a meaningful shift in how risk is being priced. Safe haven demand rises when predictability declines, persistent inflation concerns, expanding deficits, and inconsistent policy signaling introduce variables that long-term capital cannot ignore. Even when growth appears resilient, investors ask whether that growth is financed in a sustainable way. If the answer is unclear, protection becomes a priority. Gold doesn't need earnings. It doesn't rely on fiscal promises. It simply exists as a store of confidence when confidence elsewhere becomes conditional. There is also a psychological element that markets understand well. Safe havens gain traction when investors sense that narratives are being used to paper over structural challenges. Markets don't object to stimulus or intervention when it's disciplined and temporary. They object when extraordinary measures become ordinary, when emergency tools become standard practice. That's when hedging becomes systemic rather than tactical. It's important to recognize that this behavior doesn't signal imminent collapse. It signals caution. The global financial system is adaptive, not fragile. But adaptation always comes at a cost. As more capital seeks insulation rather than exposure, the efficiency of capital allocation declines. Risk premiums rise. Borrowing becomes more expensive. Growth becomes harder to sustain without increasing leverage. These are second-order effects that take time to show up, but they compound quietly. The rise of safe haven assets is not an indictment of markets. It is a mirror. It reflects what investors believe about future discipline, future governance, and future credibility. Ignoring that signal would be a mistake. Markets are not emotional, but they are unforgiving. Once they recalibrate their definition of safety, reversing that perception requires consistency over years, not reassurance over quarters. Ultimately, capital is not fleeing opportunity. It is demanding accountability. It is saying that stability must be earned, not assumed. And until that expectation is met with credible, sustained action, safe havens will continue to attract the very capital that once flowed unquestioningly into risk. Reputation is an asset, and like any asset, it compounds when managed well and deteriorates when neglected. For decades, the economic reputation of the United States functioned as a silent guarantor. It reduced borrowing costs, attracted global capital, and reinforced the dollar's central role without the need for constant defense. Investors trusted that even when policy shifted, the underlying commitment to stability, rule of law, and long-term discipline would prevail. That reputation did not emerge by accident, and it will not survive on autopilot. Today, the concern is not about one policy decision or one political cycle. It is about the accumulation of signals that suggest unpredictability is becoming normalized. Markets can adapt to almost any framework as long as the rules are clear and durable. What they struggle with is inconsistency. When fiscal restraint is promised but not delivered, when emergency measures linger long after the emergency is passed, and when long-term consequences are deferred in favor of short-term relief. Global investors do not separate rhetoric from outcomes. They look at debt trajectories, demographic pressures, and policy follow-through. They assess whether institutions are being strengthened or strained. When debates over budgets, ceilings, and obligations become recurring sources of instability, confidence begins to erode at the margin. And erosion, by definition, is incremental. It doesn't announce itself in a crisis. It shows up in higher risk premiums, greater hedging, and reduced tolerance for surprises. The idea that a developed economy can gradually adopt the characteristics associated with less stable systems is uncomfortable, but it's not an insult. It's a warning. Those characteristics are not about income levels. They're about governance quality, institutional predictability, and fiscal coherence. When infrastructure, sector underinvestment persists, when regulatory frameworks shift unpredictably, and when political polarization interferes with economic stewardship, perception changes. And perception matters because capital moves on perception long before data confirms it. What makes this especially consequential is the interconnected nature of modern finance. Capital has more choices than ever. It can move faster, hedge more efficiently, and diversify across jurisdictions with ease. That means reputational damage doesn't stay contained. It affects currency demand, foreign direct investment, and the willingness of global partners to commit capital for the long term rather than the trade. Once that shift occurs, rebuilding trust becomes far more difficult than maintaining it in the first place. This is not about pessimism. It is about realism. Strong economies are not defined by the absence of challenges. They are defined by how those challenges are addressed. The question markets are asking is whether long-term discipline remains the guiding principle or whether short-term convenience is taking precedence. The answer to that question will shape investment behavior more than any single data release. Reputation, once weakened, demands proof to be restored. Not declarations, not optimism, proof. Proof in the form of consistent policy, credible fiscal frameworks, and institutions that demonstrate resilience under pressure. The world does not expect perfection, but it does expect seriousness. And in global finance, seriousness is measured not by intention, but by execution. Capital has always been pragmatic. It does not pledge loyalty, and it does not wait for certainty. It moves where risk is compensated, where rules are respected, and where outcomes are reasonably predictable. In recent years, what we are seeing from global investors is not withdrawal, but recalibration, 4I. GN Capital is still participating in U.S. markets, still backing American companies, still recognizing the innovation and productivity that define the economy. But it is increasingly doing so with protection built in. This hedging behavior is telling. Investors are separating two ideas that were once closely aligned: confidence in corporate performance and confidence in the currency that denominates it. That distinction matters. It suggests that while businesses may remain globally competitive, the macro framework surrounding them is being treated with more caution. Currency hedges, diversified funding structures, and alternative reserve holdings are no longer exceptional tools. They are becoming standard practice. From an investor's perspective, this is rational. When fiscal trajectories are unclear and political outcomes introduce tail risks, hedging becomes a form of discipline. It is not a statement of disbelief in growth. It is an acknowledgement that growth alone does not neutralize macro risk. Capital allocators are tasked with protecting purchasing power across cycles, not maximizing returns in a single environment. When uncertainty rises, so does the cost of confidence. What's notable is how sophisticated this hedging has become. It is not blunt or reactive. Investors are not abandoning exposure, they are refining it. They are participating in equity upside while insulating portfolios from currency volatility. They are financing innovation while diversifying geopolitical risk. This approach reflects a world in which trust is no longer binary. It is conditional and priced accordingly. The long-term implication of this trend is subtle but important. As hedging becomes more widespread, it introduces friction into the system. Hedging has a cost, and that cost ultimately shows up in valuations, borrowing rates, and capital efficiency. Over time, this can dampen the advantages that once came from being the unquestioned center of global finance. Dominance, when unquestioned, is efficient. Dominance, when hedged, is still powerful, but less so. There is also a signaling effect at work. When foreign investors feel compelled to hedge systematically, it sends a message that confidence is being rationed. That message doesn't require commentary or criticism. It is embedded in the structure of trades. Markets listen closely to those signals because they reflect decisions made with real capital, not opinions expressed without consequence. This moment calls for perspective. The U.S. remains a magnet for talent, innovation, and investment. That has not changed. What has changed is the margin of trust, and margins matter in finance. They determine pricing, leverage, and resilience under stress. Restoring that margin does not require dramatic gestures. It requires consistency, transparency, and a renewed focus on long-term stability over short-term expediency. Hedging is not hostility. It is a mirror. It reflects how the world is adjusting its expectations. And if those expectations are met with clarity and discipline, trust can be rebuilt. But if they are dismissed or underestimated, hedging will harden into habit. And habits once formed in markets are remarkably difficult to break. Economic systems don't unravel in a single moment. They drift. The warning signs are rarely dramatic, and that's precisely why they are so often dismissed. What we are confronting today is not a crisis defined by collapse, but a convergence of pressures that, left unaddressed, can reshape outcomes over time. Rising debt, persistent deficits, political polarization, and institutional strain are not new challenges. What's new is the degree to which they are being treated as permanent features rather than temporary conditions. Markets are forward-looking by nature. They don't wait for consequences to fully materialize before adjusting. When long-term obligations outpace credible plans for growth and repayment, investors don't panic. They recalibrate expectations. When fiscal debates become recurring standoffs instead of structured processes, uncertainty becomes embedded. And when governance appears reactive rather than deliberate, risk premiums begin to rise quietly in the background. Critics who use provocative language to describe this trajectory are not necessarily predicting decline. They are highlighting slippage in discipline, in accountability, and in long-term thinking. The concern is not that the economy lacks capacity or innovation. It has both in abundance. The concern is whether the systems designed to steward that capacity are being reinforced or gradually weakened by short-term compromises. Debt, in particular, deserves sober attention. Debt can be a powerful tool when it finances productive investment and future growth. It becomes a liability when it substitutes for difficult decisions. Markets understand this distinction clearly. When debt expands without a credible framework for containment, confidence erodes incrementally. That erosion does not show up immediately in daily headlines, but it compounds in funding costs, in currency valuation, and in reduced flexibility when the next shock arrives. Institutional credibility is equally important. Strong institutions do not require perfection, they require predictability. When rules are consistently applied and obligations are honored without theatrics, trust deepens. When those same processes become politicized or uncertain, trust thins. And once trust thins, restoring it demands sustained evidence, not reassurance. The idea that advanced economies are immune to these dynamics is comforting, but historically inaccurate. Economics stand. Ding is not guaranteed by status. It is maintained by stewardship. The world does not downgrade confidence all at once. It does so in increments, adjusting exposure, shortening time horizons, and demanding higher compensation for risk. By the time those adjustments are obvious, they are already entrenched. This is why acknowledgement matters, not alarmism, acknowledgement. A willingness to confront long-term realities, to align commitments with resources, and to prioritize institutional strength over political convenience. Growth can coexist with discipline. Innovation can flourish within structure, but neither survives indefinitely in an environment where trade-offs are deferred and accountability is diluted. The path forward is not about reclaiming a narrative, it is about reinforcing foundations. Markets respond to actions that demonstrate seriousness of purpose. When discipline is visible and consistency is restored, confidence follows, not instantly, but durably. And in a global system built on trust, durability is the most valuable currency of all. So here we are, not at the edge of collapse, but at the edge of choice. History will not remember this moment for what was said on television or argued online. It will remember what was done quietly, deliberately, and decisively, or what was avoided until it was too late. Because the most dangerous phase of any great system is not when it is weak, it's when it still appears strong. Markets are patient, but they are not forgiving. They don't shout, they don't vote, they don't negotiate, they adjust. And once that adjustment becomes permanent, no amount of confidence can reverse it overnight. This is the moment when leadership matters more than narratives, when discipline matters more than optimism, when credibility must be proven, not promised. The world is not asking for perfection, it is asking for seriousness. And seriousness is measured not by words, but by consistency over time. The future will belong to those who recognize that trust is the real reserve currency. Lose it, and everything becomes more expensive. Capital, growth, stability, influence. Protect it, and strength compounds quietly, year after year, even in uncertainty. The question now is simple but uncomfortable. Will this moment be treated as a warning or as background noise? Because the world has already started to prepare. Capital is repositioning. Risk is being repriced, assumptions are being rewritten, and history has taught us one thing with brutal clarity. By the time these shifts feel obvious, the opportunity to lead them has already passed. So don't watch the headlines, watch the signals, watch where confidence is flowing and where it is hesitating, because the next chapter of global power won't be decided by who speaks the loudest. It will be decided by who acts with discipline when it still matters. And when this era is finally judged years from now, the verdict won't be emotional. It will be mathematical. Thank you for staying with me. Stay alert, stay informed, because the quiet moments are the ones that change everything.